Nice to be with you. I'll try and be brief. Who are we at Hamco? We're advisors to the Hamco Global Value Fund. Let's see if we have a cursor here. Which was founded at the end of 2019. Our combined track record of the two funds we've advised over the last 20-something years is 18% per annum. We're global and deep value investors. We've invested in 35 countries over the history or more. To give you an idea of what we do, this is data from Morningstar in terms of valuations, P ratio, and price to book versus the index. So you can see that we're really deep value. You can see the style boxes here where the fund we advise is outside of the box. Our historical returns over the last 3 years, over 20%. We were also positive in 2020. So the NAV is up, I think, 135% of the main share class since founding. An update on the pitches we made in 2021. We recommended Peyto. It's a Canadian gas company. You can see the price of Canadian gas in yellow and the Peyto stock price. It's sort of, since they hedge quite a bit, the stock price follows the gas price. It's up 150%. We still own, in the Hamco fund, we still own Peyto, although a smaller position. Sort of lagged the increase in gas prices, still undervalued, paying a 9% dividend yield. And they bought Repsol's assets at the end of last year, so still growing. We also mentioned another company, GasLog Partners, which has LNG vessels, and that was acquired by our parent, the parent company, sort of as expected, at a very low valuation. Pre-COVID, it was at $15 or $20 a share, and they took it out at, I think at least it's in euros, but around 8. But still a very nice result in a short period of time. What are we looking at today? Investment cases, Korean value, stocks in general. Korea's in the process of setting up the Value Up program. I'm not sure if you've heard of it. It's quite a bit in the news in the last month or two. But it's inspired by Japan's corporate governance reforms. Japan has made quite a bit of progress in naming and shaming companies that trade below book value. And Korea wants to eliminate the Korea discount. They perceive their local stock market is undervalued versus their global peers, and want to eliminate the Korea discount. So they're setting up this Korea Value Up program, which will be, I think they will present the final details in May. So it's sort of a work in progress, but shareholder return guidelines, a new index to promote value-adding companies, and government support, including tax incentives. This has been a pretty big deal for companies in Japan. If you've been aware, or the Japanese stock market is at all-time highs recently, and there's been quite a bit of progress in terms of companies, buying back stock, a bigger focus on return on equity, and this is already happening in Korea. I think the program's been up and running in Japan for quite a few years now, and I think it'll be maybe much faster process in Korea. This is some details of what the FSA, the agency, disclosed in January 17th in terms of tax incentives and the Value Up program. A lot of Korean stocks jumped in January on just the news that this was coming. And when they presented the draft plan and a couple of weeks ago, the stock market went down a bit for a few days, and now it's rising again. This is the distribution by country of the Hamco fund. We have 26% of the fund in Korea at this point. We basically bought into Korea because we thought we weren't particularly comfortable with the China risk, And we thought it was the least expensive market. In terms of finding deep value, that was the best opportunity we could find on a global basis. So we have a big investment in South Korea, even before the Value Up program. This is our exposure in Korea. You can see it's quite diversified with banks, insurance, brokers, consumer discretionary. I don't know the exact number of companies we have in Korea, but it's very diversified amongst industries, and it's more a general play on deep value in Korea. We're going to focus today on Korean banks. It's almost a shame that recommending banks, because I don't know, we at Hamco, we're reluctant to invest in banks because they're highly levered and generally can have a lot of unfortunate surprises. But it's one of there are Korean ADRs for the Korean banks, and many people can't invest directly in Korea, so we thought that would be an acceptable candidate. We do have investment in Korean banks, but I don't know, I'm always reminded by the 100 Baggers book. I don't think there are any banks in the 100 Baggers book. There are plenty of insurance companies or other industries, but I don't think there are any banks. So always some crisis comes along, and the leverage is a problem. We think the Korean banks are good businesses at good prices, attractive risk return. Management was already working on increasing shareholder payouts before the Value Up program. As an industry, they were promoting more buybacks and return on equity beforehand. So just as background, the valuations have been in the doldrums for years, even though return on equities have increased. They're far from stellar, 8 to 10% range in recent years. But higher rates have helped, and probably there's been a bit of a slowdown, not an actual recession in Korea, but in some real estate issues. We think the industry would do well, and a good proxy for the overall economy. And increasing dividends and buybacks will help. The overall industry, you can see the four main listed banks there, KB, Hana, Shinhan, and Wori. Are the largest banks and are all listed. Next are sort of government institutions. Some overall statistics on the banking industry. I think in the lower right you can see like the household loan growth, dipped in 2022. Wasn't a recession in Korea, but loan growth has started picking up, and I think also. We were attracted to Korean banks for one reason, that rates had gone up in several countries in the world, and they'd gone up in Korea as well, but the banks hadn't reacted. Their banks were actually cheaper, so they didn't follow. Like European banks have gone up quite a bit in value in the last year or two, and Korean banks were still attractively priced. Here you can see evolution of buybacks in the top panel, payout, and dividend yield, and where green is the more attractive. So some of the banks had issued shares in prior years, and now they're starting to buy back. In terms of payouts, ratios have generally increased, and dividend yields are getting much more attractive than in the past. On a valuation standpoint, you can see that, in terms of price to book, KB, the 0.4 to book, quite attractive valuation, 3, 4, 5 times earnings, and return on equities are 9%, say, on average. So we think the valuations are attractive there, particularly with the Value Up program. Here you can see a graph of the price to book evolution. So they're still quite low versus the historical perspective, which is one of the things we like to buy at a low price. And the evolution of return on equity over the over the last 10 years, say, have increased from the lows of 2013, 2014. You can see that Worry has had earnings problems in 2013, 2014. We actually in Hamco, we own all of these three except for Worry. You might think, oh, why? Maybe you could find which was the most attractive bank of the three and just buy that one. Well, I don't know. In my experience, it's quite difficult to do that. We've had situations where we've invested many times in an industry, and I think probably more times than not, it's been the companies we've had a smaller exposure to have gone up more than the ones we thought, not just because the way the market misprices things. We think we've chosen the right company to invest in or focus on, and the market often disagrees for a period of time. The Korean banks definitely have risks. Property finance is one. The real estate market with higher rates has suffered a bit in Korea, but the risks are, in our opinion, manageable. They do also have overseas exposure to commercial real estate, but it's quite low percentage of Core Tier 1. I think Christian sends the presentations around after, so we can go through this quickly. You can see like mortgage delinquencies have risen, but they're infamous at 14 basis points or something like that. Delinquency is 25 basis points. Credit card receivables, delinquencies, substandard loans have increased, but are still at low levels. And they have strong buffers. We'll compare, compared to Santander later, but they have good coverage of non-performing loans. So we think it's relatively safe. Wanted to, instead of go a little bit deeper into KB Financial, which is the largest bank, also has US ADRs in a little bit more detail. This is the breakdown of their major subsidiaries. You can see that the main bank is about 80% of the business. They've been pushing more into insurance and other activities, but the core banking business is the bulk of the business. There's some more detail on the subsidiaries. One of the things we've looked at with, we like to do regression analysis comparing the 2-year interest rate in Korea on the x-axis and the price to book on the y-axis. Look at the regression. This is since 2000. You can see that there's about an 80% revaluation up to the red line. This would imply that as rates go down, the price to book should decline. So in the case that rates go down, valuation could come under pressure. But generally, I think we're at one of the lowest price to book in the last 20 years. So generally should be upside. And I think I wouldn't expect rates to go to the levels they were pre-COVID. I think that's the general expectation going forward. This is, probably can't see this here, but this compares Santander on the left to KB on the right. You can see generally the return on equity here in the middle has been a bit better at KB, but I think the biggest difference is like common equity to total assets is about 5% at Santander and almost 8% at KB. So you have a lot less leverage at KB. If you look at non-performing loans, Santander has 3.5%, whereas KB has 0.5%. And coverage of NPLs is 63% at Santander and over 200% at KB. I mentioned Santander because it's probably a bank that many people recognize. We've come close to investing in Santander. They're buying back shares and this and that, but we haven't invested there. But we've always found that we can find outside of Spain other options that are less risky and with more potential upside. So a few graphs on the recent performance of KB, generally trending in the positive direction in terms of net interest income as rates have gone up, fees and commissions, expenses are trending down, probably in part due to a good evolution of revenues. The assets and NPLs, well, they have been rising in the lower right. They're still manageable. Credit costs and here group NPL coverage at 174%, a bit different than the Bloomberg data. So it seems like a high quality institution with good core tier 1 and quite good growth, particularly in recent years. So estimating expected returns, just big picture. I will caution, these numbers are, we put the presentation together last week and the price has moved a little bit. The same thing happened last time we presented with Peto. I think Peto was up the day before we presented up like 7% or something, but directionally they will be correct. Assuming an average return on equity of 8.5%, payout ratio of 45, and a 2% annual buyback, you get these different expected returns depending on how much revaluation there will be. You know, generally in the Japanese program and in Korea, they're targeting companies that trade at less than book value. So one would think that if you're the largest bank in Korea, you know, they would have a good incentive to get to 1 times book. Seems to be a reasonable valuation. So a 3-year expected return would be 45% in that case. If 0.6 to book would be 24%. So they seem quite attractive returns given the risk for a highly liquid stock with a nice dividend yield while you wait. There are a number of risks. The general risks of banking business in general is probably the biggest one. You know, high leverage, you know, exposure to real estate, which we talked about before. I think probably the biggest two are probably at the bottom in terms of geopolitical risks with North Korea. I mean, this is something that's been a risk for, I don't know what, the last 70 years. But the world is a bit more conflicted place these days, so who knows? And I think long-term demographic challenges in Korea, the birth rate is very low, one of the lowest in the world, so the population will start shrinking and probably means lower interest rates at some point. So there are, it's not without risks. So yeah, of the 4 big banks, KB, Shinhan, and Warwick have US ADRs, and Hana Financial does not. Yeah, that's basically what we have today. I think the thing to consider is Korean small cap value, I think, is a very attractive hunting ground for investments. We have a very large position, which we're not particularly comfortable with. We like to have a diversified portfolio, and 27% is quite a big exposure for us. I think it's a sign of that we have a lot of optimism that the Korea Value Up program will do good things for undervalued Korean companies. So I think it's worth considering. The banks, I think I would be cautious with them. I mean, we have 3 banks, and I think they're all like 1% positions in our fund. They're not huge convictions, but they seem to be attractive risk rewards. So that's what I have for you today.
Any question? Yep.
Well done on the bank trade, and I was looking at performance. They've been 48% for KB year to date. Is it, my first question, is it still I mean, you still see upside there, I guess. But is there any other company in Korea that you would think is attractive?
Yeah, it was the more upside. I think probably, I think our target valuations are 1x book would be a minimum over the medium term. I think that it will take time. I mean, the Japanese program took years, and there's still plenty of companies trading at below book value in Japan. But it's encouraging, the number of comments already in calls and presentations about the Value Up program in Korea. And I think it will help. It's really difficult to trade in Korea. Individuals, I don't think, can trade in Korea today, and I think they're working on that. I think the Korean market will open up generally. They'll publish more documents in English. So I think there will be, over the next 3 to 5 years, there'll be a big change, and I think there'll be a big re-rating of all sorts of companies. We have we have a huge number of Korean equities, and I won't recommend anyone particular, but the CNMV, our documents have all our positions in there, and you can see them by size. And we have a mix of, conservative, defensive. I mean, you can buy companies, consumer goods, food companies at 6x earnings, deep value conglomerates at 3x earnings, energy companies at 3x earnings, 10% ROE, return on equity over the last 10 years at 30% of book value with a nice dividend. The opportunities, we spend all our time looking globally for the best investment ideas. And we've been invested in Turkey and Argentina, South Korea, South Africa, Canada, and it's the best opportunity that we've seen in recent years.
Thanks for the presentation. I unfortunately have invested in a few Korean small cap stocks and I've learned a pretty painful lesson being a minority shareholder in controlled vehicles. Really unexpected things have happened. And I've looked at this Value Up program, and it looks really interesting, but it doesn't strike me as similar to Japan in the same way, because I think in Korea it seems like 80% of the companies are family controlled. They have an inherent bias to keep the stock price down because inheritance taxes are like 60% or something crazy. So there's all the self-dealing and majority shareholders who basically do related party transactions, even to big companies like Hyundai, for example, when they bought that huge property. I mean, do you think that the regulations will change? Because Japan, it seems like, regulations are on your side, and it was more just apathy in terms of the valuations and moving to book, naming and shaming. Whereas in Korea, I think it seems to me it's more just pandering right now, and you need some regulations to change to benefit minority shareholders.
Yeah, that's a very good question. The markets are quite different, and the formal program hasn't even been announced, so it's not clear. I think mistreatment of minorities is a disease that runs the whole world, and I think the best defense of that is we try and look at a 10-year financial history and look at the deals the companies have done. Have they added value or not? And I think you can avoid a lot of bad apples by looking at a long history and seeing the evolution of the company, and do they issue shares at low prices? Do they buy companies at outrageous valuations? I think you can avoid a lot of things. I don't think the Value Up program will target those sort of transactions. I think those will probably still continue to happen, but we've had surprises in different markets with those kind of things. It can always happen. But I think the Value Up program will help push companies with a better focus on return on equity and increase their valuation and pay out more returns. In general, I've seen the Korean companies as more forward-thinking, more focused on growth than the Japanese companies, which are their only metric, 5 or 10 years ago when I started going to Japan was, operating margin. That was their, we want to get a 5% operating margin. I think Korea, they're more advanced in terms of their thinking, in terms of return on equity, and they're more focused on building and growing businesses than in Japan. And I've seen that this initiative is coming from the government, whereas in Japan it came from the stock exchange. And when the government wants things, generally they get it. If they want to tax you, they'll find a way to tax you, or if they want to eliminate the Korea discount, I think they will find a way to do it.
Mm-hmm. Okay, thanks.
Hi, curious if you could share any words on Turkey, if you've been active there, any interesting opportunities. Thank you.
Right now, we don't have any investments in Turkey. I think valuations have gone up a lot over the last couple of years, and inflation has increased recently, and interest rates are on the rise. And we're not that, since they haven't implemented inflation accounting, it's also a bit more of a black box as to what the real earnings are. I think, you can find a lot of low PE companies on historical accounting, but I think given the high inflation, you need to look at inflation-adjusted return on equities, and then a lot of companies don't look that interesting. So I think it's a bit more complicated than... we haven't been that impressed with the opportunities given the uncertainty around inflation risks. So, but they're great companies. We've been invested in Coca-Cola and IFS and other companies there. There are good opportunities, but it's tricky, particularly when you look at real return on equity.
Hi. You mentioned that you are not too comfortable with China. Maybe you can expand a little bit on why not?
Sure. We divested all our positions, or recommended divesting all our positions about a year ago, just because of the Taiwan situation. After seeing what happened with all the Russian equities and all those positions getting forced to divest or not being able to trade them, it seemed to be too big of a risk. The valuations are impressive in China. We actually do have one investment in China we bought recently. It was like too cheap to ignore. But since we can find similar returns in Korea, we felt more comfortable investing in Korea than in China. So we've focused there. We think Asia is much better positioned to take advantage of global recovery. Interest rates haven't gone up as much. They didn't go up in Japan. They went down in China. So we think US, Europe, maybe still some catch up in terms of the monetary impact of higher rates. So we feel more comfortable. I think we have 40-something% invested in Asia. So, but I think Korea or Japan is probably a safer way to play, and we've been able to find similar returns. I have to admit it is tempting, but just seems like global conflict is a bigger risk than I think maybe we realize.
Thank you so much.